Okay, hello everyone. Welcome and thank you for joining us for a new session of the Risk Management School. Before we begin, we'd love to know where you're joining us from today. Let me check if the chat is available for everyone. Okay, now. So before we begin, we'd love to know where you're joining us from today. Feel free to share your country or city and chat and let us know you are here with us. Across Africa, regulations around risk, compliance, and governance are evolving quickly, and many organizations are navigating these changes in real time. That's why sessions like this matter, because they help us pause, understand what's changing, and think about how to respond in a practical way. Before we get started, a quick reminder, we prepare a free ebook, the African Risk Manager's Playbook, with simple, practical tools to help you assess where you are today and what to focus on next. You'll find the download link in the chat. And now it's a pleasure to introduce you, Isabela. Many of you know her. She works closely with our clients across Africa, supporting them as they navigate regulatory changes and day-to-day risk challenges. Isabela, over to you. Welcome.
Hello, Maria Lisa. Thank you very much. I'm very excited. I'm very happy to be here today with all of you guys, sharing this information that I know is going to be of much value and that I know that will add up onto your personal and professional growth. Okay, so let's begin. Just as we mentioned, this session is going to be about Africa's new regulatory horizon and what financial institutions need to know. Okay, so just to continue and to introduce the session, I want to show you this graphic. So what we can see here is pretty much a cycle in which we have the regulatory shift that's happening. So you can see right here on the left side that you're going to be able to find a reactive and approach that's shifting from an integrated and proactive approach. Okay, so it used to be fragmented, and we have different, let's say, factors that are going to go together that are also in order to shift from this fragmented approach onto the integrated and proactive approach. So there are 5 pillars, or let's say pieces of the puzzle that we're going to discuss, and are these ones that you can see here. So one of them is a prudential regulation. Second is AML and CFT regulation. Also climate and ESG, cyber and operational resilience, and conduct and consumer protection. Okay? So knowing that, it's important to understand that this shift, it's like a philosophical or a approach shift in which risk is no longer something that's administrative. It's not something that you have to check off the box, but it's becoming the organization principle for sustainable institutions. Okay, so let's say that the old reality, the way it used to be before these new regulations that we're going to see in a moment, was reactive. So it was not based on planning and on a good strategy, but it was also fragmented. And as I told you, just to check off boxes of being compliant and doing, let's say, a risk listing instead of a proper risk management. Now, on the other hand, the new reality is more integrated, is more proactive. It also takes into account a lot of different factors in order to move and to integrate all of these principles to have a much more robust strategy for you guys as financial institutions and banks, which is more outcome based. Okay. Now, knowing this, we are going to check on to pillar number 1. So pillar number 1, or the piece of the puzzle, is prudential regulation. It's important to understand that African supervisors are aligning with global standards of Basel III. Just to refresh and for everyone to be on the same page, Basel III is it's a global framework that pretty much it's a standard that's designed to make banking safer. So this let's say, was born after the financial crisis in 2008. And what it does, or its incidence right now in Africa's regulatory framework for financial institutions, is that it requires to hold more capital and keep enough liquid cash on hand to survive financial shocks without needing the help or assistance from the government, okay, in case of a crisis. So that's how Basel III was born. And it's important then to, after knowing this, identifying which metrics Basel III framework is now shaping financial regulations in Africa. So first of all, we have the LCR, or the liquidity coverage ratio. And this pretty much is the way to answer to the question is, do you have enough cash to survive a 30-day run? The LCR is not just a generic accounting number, it's a stress test. So it's designed to answer a specific question. If the market crashes, okay, and customers rush to withdraw all of their money, all of their deposits, can you survive for 30 days without any help from the government? Liquidity ratios are also a defense mechanism against panic when a crisis happens. And maybe it's not even a real crisis, but panic, okay? So if depositors believe that a bank is not liquid, is illiquid, they rush to withdraw all of their funds. And they create a self-fulfilling prophecy, which is a bank run, which is always negative for the banks. So in order to tackle this, now prudential regulation is much more strict on how much liquidity banks have, which also increases confidence. This is also a very important factor because a high liquidity ratio signals to the market that in other banks that this institution is safe, even when there's crisis or instability. It signals that this is a safe institution that has, let's say, like the guarantee that we'll have something to answer customers with in case of a crisis. Okay. The other key metric is the NSFR, our net stable funding ratio. And pretty much this, what it tries to answer is, are you funded by stable long-term deposits? Let me explain a little bit more on this. So the NSFR prevents a dangerous banking behavior that's called maturity mismatch. So it is very profitable for banks to borrow money for cheap with low interest rates and then lend it out for a longer period of time and with higher interest rates. This is what's called a maturity mismatch. But what happens is, I'm sorry, that the risk is that if the short-term lending market freezes, so the short-term asset that they borrowed freezes, just as it did in 2008 crisis, the bank still has the 20-year mortgage and has not new cash coming. So they don't have income to fund that mortgage. So that bank becomes insolvent because its funding dried up. So that's where the issue is. And this key metric, the NSFR, require banks to fund long-term assets. So it makes them fund mortgages, machinery loans, and assets with long-term stability, stable money, like, for example, also customer saving accounts that are saving accounts or 5-year bonds, okay? In the past, success was often defined, let's say, merely by return on equity, okay? How much profit the bank was making for every dollar of shareholder money. But now, under this new regulatory framework of Basel III, success is redefined now as resilience. So in Africa, volatility is high. Banks with high capital and liquidity buffers are seen as safe, right? So research on African banks, let's say, for example, Nigeria, Kenya, and South Africa specifically, shows that those with these higher buffers actually become more efficient and stable over time because they attract cheaper funding from investors and investors trust them. Okay. Also, African banks often face currency shocks or political instability, which is very common. So high capital buffers allow them to absorb these macro crises or shocks without collapsing, avoiding the need for taxpayer bailouts. Okay, let's move on. In this picture, we can see the difference between the old way or the old regulation and the new regulation. So on the left side, we can see a bucket full of water. Now, just to explain a little bit more, the water is how liquid a bank or a financial institution is. So water flows in and out. And if the bucket runs dry, the bank stops working. It's not liquid enough. The thickness, from the bucket is the capital. Okay, so we can see that on the left side is the thin capital, low cost, and the strength of the bucket it's not strong enough. So liquidity is filtering out of the bucket. And what happens is that if this bucket is hit by a financial crisis, it's not going to be able to resist, and the bank is going to become insolvent. Now, for the right part, we can see that there's a thick capital. Of course, this represents higher costs, but a thicker bucket with more capital costs, even though it costs more to build, it guarantees the water stays inside. It guarantees the resilience from this bank, the solvency, and the liquidity from this bank. Okay, that's why it's very important. Now, for pillar number 2, we are gonna talk about AML and CFT regulations, and this is much more in the financial integrity imperative. So the Financial Action Task Force FATF placed South Africa and other African countries like Nigeria on the gray list. This is something that is common knowledge. I know that for all of you being on financial institutions and working actively on these ends. But it's this not only happened because they didn't have any laws or they didn't have regulations in place to tackle this, but because they weren't actually enforcing them or performing them effectively. So the consequence is that being gray listed raises the cost of doing business. This is very negative because international banks, like let's say JP Morgan or the German bank, treat every transaction from a gray listed country as a high risk transaction, which basically translates into payments that are slower and also more expensive. So it's not attractive for a foreign country or foreign bank to come and invest in these types of companies in which they know the country is gray listed as not being, let's say, compliant enough. I'm sorry. So the problem is the Financial Action Task Force placed South Africa, well, as I told you, on the gray list. And the consequence of them being on the gray list and brought this increase in the interest rates and the investments. But as you know, South Africa, for example, was recently removed from that list about 2 months ago on October, ending of October. The goal and the reason for this is because this increased scrutiny on regulation on this end. Okay, so this pillar is about compliance as a strategy, and it was achieved in South Africa. So it was about proving to everyone else that your bank is not accounted for dirty money. And how did they do this? How does this happen? So in the past, fighting crime, let's say, was something from the police, the police. But under FICA, the government has effectively, let's say, deputized the private sector. So now the responsibility is not only from them, but also for every single entity and stakeholder in that entity. So if money is laundered through your bank, you are liable. You cannot simply say, we didn't know, we didn't keep track of that, we didn't take that into account. No, you have a legal duty now to know. This now includes not just banks, but insurers, also investment managers, and even crypto providers. The risk-based approach is basically that it used to be rule-based. So now it's risk-based. It used to be rule-based. And it was pretty much like, did we get a copy of the ID? Yes. Okay, so open the account. So the process was very, let's say, not as intense or as clear as it should be. Right now, the way it's standardized and it's mandated to be is that it's risk-based. So yes, we have the ID, but who is this person? Are they a politician? Are they from a high risk jurisdiction depositing cash? Then this is a high risk account. Excuse me. Moving on. So every institution now, because of this, must have a risk management and compliance program. This is something that will prove that you are actively thinking about risk and not just following a checklist. Okay, so it's risk management instead of risk checklisting. Okay, which is something that we always try to promote. Now, a different aspect, or the second aspect that is also being tackled in terms of this regulation from the second pillar, is the criminals don't open accounts in their own names. Sometimes they use shell companies, they use trusts, and this is always moving on. There's always new ways of fraud, and there's always new ways of money laundering in order to let's like hide this. Okay, so it's important because since there's always new ways to tackle them, new problems, they must always become into new solutions for these problems. And what the General Laws Amendment Act did was it forced a massive change. So you can no longer just accept a company registration document as CIPC. You must drill down until you find the ultimate beneficial owner, or the UBO. Okay? So this means it's not just the company, but let's say the warm body, the actual human who owns or controls this entity. The standard is that if you do not know the human, you cannot do the business. Okay? The third component of this pillar is reporting deadlines. So this is the most operational part of it, and is that automation is critical here because deadlines are very tight. Now, if a client, for example, if a client walks in with 25,000 Rand in cash or sends money abroad, you have 48 hours to tell the Financial Intelligence Center, the FIC. If you find a client on a terrorist sanction list, you have 5 days to tell the FIC. And if something just feels wrong, if you feel like there's a suspicious transaction, you have 15 days to investigate it and also report it to the FIC as well. Okay? Very good. Now, if prudential regulation is the engine that keeps the bank running, pillar number 2 is the shield that protects it from criminals. So we are seeing a fundamental shift in responsibility. The regulator is telling us that you are the gatekeepers, okay? The accounting accounts, the accounting responsible ones. Under FICA, it is no longer enough to just verify a client's identity. We must know who the human being is behind this and to understand the risk. This is the risk-based approach, not the rule-based approach. We have to stop treating, let's say, a grandmother saving for a funeral, the same way that we treat a politically exposed person moving millions in money. Okay. But it's also important to know that the biggest operational challenge here is the beneficial ownership. So hiding behind shell companies these days are over. If you cannot identify who the warm body, the actual human is behind every corporate structure, you cannot onboard that client. Very important to note. And finally, look at the timelines. You have 48 hours to report cash threshold transactions. In a large bank, that is impossible to do manually, right? So this pillar isn't just a legal challenge, it's also a data challenge, okay? So this was for pillar number 2. Moving on to pillar number 3, we have cyber and operational resilience. So now, the philosophical shift that was on this specific pillar is that it became from security to resilience. The old way was like build a higher wall to keep the hackers out. It was a focus on prevention. But the new way is to make it towards resilience. So you have to assume that the wall will be torn down. You have to assume that you're going to have a cyber attack and that you will be breached. And the new objective is to identify and design a strategy that allows you to bounce back and fast as a focus on a recovery from any type of breach. It's more towards resilience. And why? Because in this digital economy, you cannot be 100% secure, but you must be 100% resilient. The regulator demands that critical services like payments must continue running even during a cyber attack. Okay? The second component is the joint standard. So the joint standard on cybersecurity and cyber resilience, for you to know, is explicitly places burden on the governing body, the board. So this means that the board is also responsible for IT, for cybersecurity. Board members can no longer say like, I'm not working on IT, I'm not a tech person. No, they must approve the cyber strategy and they must ensure the bank has enough budget and let's say their whole corporate strategy must be aligned so that the talent is also managing these risks. If the bank fails due to cyber negligence, then responsibility is also on the board. The board is accountable as well. The next component is third parties or risk from third parties. So banks today are a web of partnerships. For example, using AWS or Azure for cloud storage, fintechs for apps, and APIs for data as well. So the rule is that you can outsource a function, but you cannot outsource the risk. Financial institutions and banks must know how to conduct rigorous due diligence on their vendors. Because if your cloud provider goes down, then the regulator views this as your failure, not the provider's failure. This is often called a concentration risk. So this means that if all banks use the same cloud provider, the same host, then one outage crashes the whole sector. So this is also very important to take into account and to know that responsibility not only lays on them now. The next component is the material incident reportment. So financial institutions are now required to report material cyber incidents to the regulator, immediately. And why? It is to prevent contagion. If a specific ransomware, for example, like a gang is attacking South African banks, the regulator needs to know instantly to warn the others from this same country, from South Africa, from this sector, to hide a breach, okay, to be alert because they already identify an attacker. And this also promotes awareness. To save face is now a compliance violation as well. So you must report any suspicion as well. And so to sum this up, Pillar number 3 represents the most rapidly evolving risk in our market, right? So just as I told you, every day there's a new type of cyber attack, and as they evolve, we must evolve with them as well to tackle them. So we are moving from cybersecurity, which is about defense, to operational resilience, which is about survival. Okay? The regulator's message is clear. We assume you will be attacked. You have to assume you will be attacked. The question they are asking is not, will you be hacked, but how fast can you recover from this? And how strong will your strategy be to tackle any type of these attacks? This brings two major changes. First of all, as I told you, the board accountability. This is no longer a problem from the guy from tech, but the board is legally responsible for ensuring that the bank can withstand a cyber attack. And the second one is a third-party crisis. So if your cloud provider fails, your AP partner fails, you are liable. Okay, you cannot outsource your risk. That risk is yours, and you must take that into account into your risk management strategy. That's why all of these risks that we are identifying from all of these new regulations that are now not from other one, but as you can see on these three pillars, the responsibility is much more towards you. Okay, so since there is more responsibility, there are more risks, meaning you need to identify these risks and manage them properly. Okay, in this new landscape, a bank's resilience is only as strong as its weakest vendor. Important to know. Okay, let's move on to the next pillar then, which is conduct and consumer protection. So the shift from this is from sales to service. So it's from David Enter, for example, to treating customers fairly. Now, let me elaborate on this. The old way used to be like the goal was to maximize sales volume, right? If the client bought a policy, then they didn't need, that was their fault for not reading well the contract. But now the new way is for a fair outcome, right? The regulator asks if this product was actually is actually providing value to the customer. Was it well explained, the benefits and all what was included with this new product? So if you sell a funeral policy to someone who already has 3, you're liable for mis-selling, for example. So that's also something that's responsibility is again towards you. The next component is the twin peaks model. So South Africa and many African nations use a twin peaks regulatory model. So the peak one, the prudential one, keeps the bank solvent. Okay, so this corresponds with pillar number 1. But peak number 2, the conduct, keeps the bank honest, which corresponds with pillar number 4. The coffee bill. So the conduct, this means that the conduct of financial institutions, coffee bill, is the game changer. So what it does is that it consolidates conduct laws across banking, insurance, and investment. And it means that all financial institutions are judged by the same standard of fairness. Okay, so that's what this does on the Twin Peaks model. The next component are vulnerable consumers. So regulators are hyper-focused on how financial institutions treat vulnerable consumers. What are vulnerable consumers? Low income, elderly, or low literacy clients are. So the rule is that you have to design products specifically for these groups. You cannot just make a copy-paste or a broad high-end investment product without having a version that's also adapted or specified for these consumers. Okay, that is now considered a conduct breach as well for vulnerable consumers. And lastly, on this same pillar, we have data privacy is now a consumer right, which is always been. But what the law says is that you cannot have consumer protection without data protection. The requirement is that under laws like the Protection of Personal Information Act, using client data for cross-selling without explicitly asking for their consent is illegal. If a client gives you data for a loan application, you cannot hand that data to your insurance division, for example, to cold call them. That's also something institutions are liable for. Okay, so summarizing once again, pillar number 4 represents the human side of regulation. For decades, the financial sector operated on the principle of buyer beware. If a client bought a bad product, it was their problem. It was not our responsibility because we told them what we had to. But that era is over. The new standard is seller beware. Under frameworks like Coffee Bill, the regulator looks at the outcome for the customer. It is no longer about the institutions, and it's no longer enough to be legal. You have to be fair. So we are seeing a move towards the state suitability testing, proving that the product you sold was actually right for that specific customer and they're safe. So considering if they are on a vulnerable group and their needs in the life stage that they are on. And this also ties directly into data privacy. In the digital age, protecting a client's money is easy. Protecting their identity is hard. So under this pillar, a data breach isn't just an IT failure, but is a violation to consumer trust, which also has to do with pillar number 2 on cybersecurity, right? So we can see that all that pillars are linking together to form and to start building up that puzzle to move to that integrated proactive approach. So ultimately, pillar number 4 asks us a simple but difficult question. Are we making money with our clients or off of our clients? And regulators are gonna ask you this, and you must answer properly, okay? So that was pillar number 4. Moving on to pillar number 5, which is climate and ESG, the new frontier. So there's 2 types of risks. It's important to understand this first, which is the physical and the transition risk. The physical risk is like collateral damage. So for example, you give a mortgage for a luxury hotel, and if there are, let's say this is on a coast or a beach, or yes, a coastal area, and if there are rising levels or storms that are going to damage that property, the value of your collateral drops to 0. The loan defaults. That's physical risk. But transition risk is the risk of policy change. So this is, for example, that you lend billions to a coal mine, and suddenly the government introduces a carbon tax, or literally the world stops buying coal. Like there's a new product that replaces coal, that's cheaper, that's more efficient, that's better, that's lighter, better to transport, easier, whatever. So the man goes bankrupt, and now you're left holding a stranded asset. So an asset that is worth nothing right now because the market doesn't even sell it or need it. Okay, that's a transition risk. On this pillar is that in the past, ESG was about, let's say, printing brochures with pictures of trees, or the famous term greenwashing, to show that we are a green institution, but without actual accountability or real results. The reality is that now regulators want to see the green asset ratio. So the green asset ratio, what does is that it changes this approach, and it calculates what percentage of your loan book is funding sustainable activities to what activities that are not, or more on carbon incentive activities. Okay, so it makes this versus. So the way this align with Basel is that there is a growing push to penalize dirty assets. So it's not that you cannot, but the way the regulators are doing it is that they are higher capital requirements for the ones that are not green, and they are incentivizing green assets as well as having lower capital requirements, for example. So that's for that component specifically. The second components are the IFRS S1 and S2 standards. Africa is adopting the International Sustainability Standards Board, or the ISSB standards, specifically for these two, IFRS S1 and IFRS S2, which correspond to general risks and climate risks. And this matters because this creates a common language, so banks can no longer hide exposure. They must disclose exactly how climate change affects their cash flows. Investors are using this data also to decide where to put their capital, because now this is a trend that is every time stronger. And believe it or not, there's a lot of investment and investors that take this very much seriously in order to decide where to invest and where to put their capital as well, to store. The next component is climate stress testing. So central banks are asking financial institutions to run scenarios like, what happens to your capital buffer if there's a drought that destroys 20% of the agriculture sector, for example? So often these tests, what they do is that they reveal that banks are far more vulnerable than they realize. And it forces them to diversify their lending portfolio now to be safe in 10 years. That's why it's important, because you are going to be submitted to this stress testing to be prepared. Okay? So in conclusion for this fourth pillar, through climate change, it was tough. It was thought by bankers that the problem was something for scientists and politicians, the common thought. But today, also financial industry regulators in Africa have made it everyone's problem, including specifically financial institutions. And the reason is simple. Climate risk is also credit risk. So, for example, if a farmer cannot harvest due to drought, they cannot repay their loan. If a coal plant is taxed out of existence, that asset on your books has no longer value. It's worthless. It's a stranded asset, so it directly affects you. And it's also something that has to do with your credit risk. So we are moving away from a voluntarily corporate social responsibility reports, and we are entering this era of climate stress testing, which is mandatory. So the central bank wants to know if a 1 in 100-year flood hits, does this bank stay solvent or not? This is the question that you need to ask yourself and that you must try to answer properly to the regulators. Under standards like this one, like IFRS S2, we must disclose that these risks have the same rigor as we disclose as our finances or your finances, for example. So it's not just banking for profit anymore, it's banking for a sustainable future. Okay? So that was pillar number 4. Moving on, pillar number 5. Moving on, we are going to integrate all of those 5 pillars. So remember the graphic that I showed you, in which they are all pieces of a puzzle that must fit in. And how do we integrate them? So we have to look at them individually, but the sad truth is that they don't happen individually. Actually, they all happen at once. For example, think about a cyber attack. It starts as a tech or IT problem, pillar number 3. But the moment customer data is stolen, it becomes a consumer protection crisis. So that's pillar number 4. Now, if that data is used for fraud, it becomes an AML failure, which means it's pillar number 2. And if the reputational damage causes a run on the bank, it becomes a liquidity crisis. So that's pillar number 1. So that's 4 of the pillars that are into one single event that happened all at once. And they all triggered different aspects that have to do with all of the pillars. So that's why it's important to have an integrated approach. Because if you have 5 different departments managing this risk in 5 different rooms, you will fail. The new regulatory reality requires us to break down this silence. We need to have an integrated risk management approach. We need to treat risk not just as a back office function, but as the organizing principle of our entire institution. We need to connect the dots between prudential, between cyber risk, and just stop complying and start seeing that if we integrate this properly, it's the way to develop true resilience in financial institutions. Now, other thing to know are the consequences of not being compliant. So the old reality is that fines were small costs of doing business, right? Now regulators are issuing administrative sanctions designed to hurt. In South Africa and Nigeria, for example, we see, for example, multi-million rand or naira fines, not just for money laundering, but for administrative failures, such as filing a report past the due date. So that's also an administrative sanction. So the point is that a fine erodes your capital buffer. So it affects your pillar number 1 directly. Okay? Let's say another aspect or consequence is the iceberg effect. So that's for remediation. For example, for every dollar, let's say, a bank pays in fines, it typically spends 10 on the remediation. So what is remediation? It means hiring expensive external consultants to come and fix what the problem caused. To manually review 500,000 past customer files because your system wasn't ready, because your system didn't track that and was, say, not well integrated. So it paralyzes the bank's growth for years because all resources are focused on fixing something instead of promoting growth, okay, and not building the future. The third consequence is reputational. So global banks like banks in New York or in London are terrified of dirty money. So if they by any reason suspect that an African bank has weak controls, they don't just find them, but they cut them off. So they literally do not even consider them, which also leaves you very way out of the market and it's a very high risk. So the impact is de-risking. If your institution loses its correspondent banking license, you cannot clear US dollars or euros, for example, in Europe. You are effectively locked out of the global economy. For a trade bank, this is a death sentence. Okay? Something that's very important to know. And the fourth consequence or impact is that the board is on the hook. So remember the pillar from cybersecurity. Under FICA and the new cyber standards, accountability is also for the board of directors. We are seeing a global trend where compliance officers and directors face personal fines or are barred even from working in the industry. So it's no longer just the company's money at stake. It's also the director's career and reputation, affecting also the institution's reputation. Okay? So to summarize, we often hear executives complain about the cost of compliance, right? The software, the staff, the training, what does that work for? How much money is that going to bring me? And the reality is that we should not talk about the cost of compliance, but the cost of non-compliance. Firstly, as I told you, there are fines. In this new landscape, the regulators aren't issuing warnings or just sanctions that's paper or report, but they are actually making administrative sanctions that consume directly into your capital reserves. So this is obviously not good. But the fine is not only the problem. The problem is that there's a cost in order to fix that problem that caused that fine. Now, remediation can even be 10 times more expensive. So if the regulator finds a gap in your AML process, for example, they can order you to manually backtest 5 years of transaction data. So this is not only time consuming, but also money consuming, and it's also avoidable. So it's extra work that you wouldn't have to do if you have a well-integrated approach and if you consider this risk. So the paralysis can stall your business for 18 months even. That's why it's very important to see this not as something that it's not on my jurisdiction, but the cost of non-compliance is gonna be very high. Okay. And the ultimate threat, which is the risking. So if global correspondent banks decide that your controls are weak, they simply cut you off. You lose the ability to clear dollars. You lose the ability to trade. So of course, this is a very high risk. In non-compliance isn't just an expense line on a budget. In 2026, this next year, and all over 2025, but next year even more, it is an existential risk. It is the difference between being a bank that operates and being a bank that actually closes. Okay? Now, this is a strategic roadmap that we designed for financial institutions, and it has 4 different stages. So, step number 1 is honest audit. So, what this proposes is not only show your policy manual, but to show your data. If the regulator asks you to, or if I ask you to identify the beneficial owners of your top 50 corporate clients, would you be able to do that? If not, that's where you have to start. Step number 2, data integration. So we need to stop, as I mentioned, treating cyber risk and financial crime as separate problems. They are integrated. They are 2 sides of the same coin. And your systems need to speak the same language between these 2 sides of the coin. Step number 3 is automation. So, for example, the 48-hour deadline on the transactions, that's non-negotiable. If you're still relying on manual reporting or your system is very slow, then you're already non-compliant. Okay? So you need to invest in tech, regulatory tech, software and management that handles the volume so your people can handle the value instead. And step number 4 is culture. So this is the most important one. We need to stop viewing compliance as something just to check or to tick off the box as business prevention department, but we need to empower our frontline staff to own their risks, to know their risks, and to report anything that has to do with them in order to have an integrated approach, not only on paper, but that is also practiced every day on the organization. Okay? So in this picture, we can see all of those 4 steps. So you can, of course, we're going to send you this presentation, but if you can take a screenshot or take this into account. But this is like a simple roadmap of these 4 phases that you must go through in order to fit all of those pieces of the puzzle properly, not fit the wrong one in the wrong place, and to achieve a resilient future. So phase number 1 is to have an honest audit, so data diagnosis based. Phase number 2 is the integration. Phase number 3 is tech sprint, so automation, reduce of manual workload and regulation tech. And phase number 4 is the cultural mind shift, so risk ownership and to own their responsibilities. Okay. And lastly, to conclude this presentation, I want to leave you with one final thought. For years, we have viewed regulation as a tax on our business, something that slows us down and that costs us money. But looking at this new regulatory horizon in Africa, I want to challenge you to flip that idea. So, in this digital world that's also mandated by cyber attacks, by climate crisis, by financial instability, political issues, resilience is the ultimate product to have. When you implement Basel III, you aren't just satisfying a regulator, you are guaranteeing your deposits liquidity and that your money is safe, as well as your reputation. And when you force strict AML controls, you are not just avoiding fines, you are protecting your economy from organized crimes. When you embrace this customer protection, you aren't just following a law, you are building loyalty that lasts also for a lot of time and for generations. So institutions that treat this shift as a checklist will struggle to survive, I might tell you. But the ones that treat this as a strategy and use these recommendations and build these pillars into their DNA will define the future of African finance, I believe. So don't wait for the audit, but build the resilience now. Thank you very much.
Thank you, Isabela, for that overview. That was very clear and helpful. We are running out of time, but I like to take a couple of minutes for some questions that came up from the audience, so we can answer it. The first question is about cyber resilience and governance. And in the section of cyber resilience, you mentioned that the board of directors is now liable. Does this mean a board member can be held responsible for a technical IT failure?
Good question. So yes, the board is just as liable as any member of the tech team. As I mentioned, they are embedded into the whole process, and as being the board of directors, they must make sure that all of these regulations are tackled, and the whole cyber strategy is focused as well, not only as something from the tech team, but from the core of the business. So yes, if they are not properly, or they are not, if there's any event due to negligence, they are held responsible and are liable.
Thank you so much. And the second question is around financial integrity and transparency. Why is identifying the ultimate beneficial owner, or UBO, often more difficult than just checking a company registration document?
Okay, so as I explained, there's different ways, and also this happens and this is evolving every day, in which this is masked or hidden. So shell companies or corporate structures that are not clear who the responsible is. So this is why these old documents, the CIPS, are not longer enough. So you must identify who the human being, who the real human or the final beneficial is behind this company, in order to be able to provide for them. So that's why it's not enough, and that's why you need that.
Okay, thank you. Very clear. Okay, Isabela, thank you again. And thanks everyone who joined us today. Before we end this session, just a final reminder, we've created a free ebook to Africa to understand more about this African new regulatory horizon. It calls the African Risk Managers Playbook, and it was designed to help risk management teams make sense of these regulatory changes and translate them into practical actions. If you haven't downloaded it yet, you'll find the link in the chat. And we encourage you to look and continue this conversation inside your organizations. Thank you for being part of these sessions. Thank you again, Isabela. And we hope to see you again soon in a new season of the Risk Management School next year.
Thank you. very much for the session, and it was very great to have it. And well, bye everyone.
Bye. See you soon.
Bye bye.